How the rich avoid paying taxes by hiding their money. The question of how the wealthy escape taxes by concealing assets is both contentious and intriguing. It uncovers a complex web of tactics and loopholes used by wealthy people to decrease their tax payments. While taxes are important for society, the extent to which the wealthy use legal and ethically dubious tactics to secure their wealth raises serious questions about fairness and equality. In this topic, we will look at tax evasion, specifically how the wealthy hide their assets and avoid paying their fair amount of taxes. We hope to acquire insight into the broader ramifications of income disparity, tax laws, and the quest of financial advantage in today's society through this inquiry. Let's look at the stories of Paul and John. Paul makes a modest $20,000 per year and regards his $7,000 tax payment as a usual requirement. He doesn't mind because he sees it as a normal part of his financial responsibility. John, on the other hand, symbolizes a different archetype. He is a different entrepreneur who has established a medium-sized technological company from the ground up. With over 50 employees and constant development, John is resentful of the high taxes he must pay. He wonders why the government takes such a large amount of his hard-earned salary, especially given his perception of scant government involvement in his company's success. As the owner of a business, John is subject to a variety of taxes. Frustrated by the high tax load, John sets out on a quest to lower both his company's and his personal tax liabilities. During his study, he comes across tactics used by huge firms such as Amazon, which avoided paying income taxes in 2018 while making billions of dollars. Motivated by the prospect of tax savings, John delves deeper into the world of tax reduction tactics, looking for ways to reduce both his business and personal tax liabilities. Method 1. Writing off expenses. Considering that numerous affluent individuals accumulate their wealth through business ventures, they enjoy the advantage of deducting expenses from their taxable income. Most of the expenses incurred in a day-to-day business operations can be subtracted from your income, effectively reducing the amount of tax you are obligated to pay. Let's consider a scenario where you own a digital marketing agency with an annual revenue of $200,000. If you had no expenses, the entire $200,000 would be subject to taxation. However, since most businesses have expenses, these costs serve to decrease the portion of your profits that is taxable. For instance, if your legitimate business expenses amount to $100,000 per year, your annual profit would be $100,000 instead of the $200,000 in revenue. Consequently, your tax liability on your earnings would be reduced by half. Eligible expenses can encompass various items such as business launches, office supplies, new laptops, internet connections, employee benefits, staff training, rent and leases, car expenditures, and more. As the business owner, you can even deduct expenses associated with attending a conference to enhance your digital marketing skills. It's important to note that these strategies for reducing taxes are exclusive to business owners, which explains why many of them tend to accumulate greater wealth compared to employees. Method 2. Diverting income. In 2017, the United States reduced its corporate income tax rate from 35% to 21%. Despite the opportunity these presented for corporations, including Amazon, to significantly decrease their tax obligations, many companies still prefer to declare their profits in countries with even lower tax rates. One such example is the Cayman Islands, renowned as a tax haven due to its absence of income tax, corporate tax, estate or inheritance tax, gift tax, and capital gains tax. This makes it an attractive choice for minimizing tax liabilities. Essentially, all earnings generated in a tax haven like the Cayman Islands can be retained in full without being subject to taxation. It's evident that these can lead to substantial savings for organizations. Consider this scenario. Your company generated $5 million in revenue last year instead of paying the 35% income tax, which amounts to $1,750,000. You would pay nothing and retain over $2 million. Additionally, the Cayman Islands has stringent banking regulations that prioritize banking confidentiality. The absence of tax treaties with other nations safeguards offshore banking clients' funds from international tax authorities. Moreover, offshore corporations in the Cayman Islands are not obligated to submit financial reports to any local government entity. Establishing a corporation in the Cayman Islands is a straightforward process. Given all these advantages, it comes as no surprise that businesses are increasingly gravitating towards these secluded destinations to safeguard their profits. Method 3. Netting revenues against losses. Starting a business may be a frustrating experience, with failure rates reaching 20% in the first year of operation, 30% in the following year, and 50% by the 5th year. After a decade, a startling 70% of small enterprises have failed. Nonetheless, many organizations succeed and amass significant wealth, necessitating tactics to protect their profits. Using loss carry-forwards is one such method. Most businesses require time to become successful, and many sustain losses during the early phases of slow growth. While these losses are disheartening, they can be beneficial for future tax planning. Loss carry-forwards, like business expenses, can be used to offset earnings, lowering overall tax liability. This method reduces the amount of income that is taxed, successfully protecting revenue while managing tax liabilities. Method 4. Issuing stock options. Giving stock options to stakeholders is another tax-cutting strategy used by firms. This approach has two major advantages. To begin with, it is classified as an expense, lowering profits and the taxable amount. Second, there is no financial loss for the company. Stocks are accounted for accounting purposes even though monetary transactions occur. This allows the corporation to cut profits while still keeping a healthy financial position. Implementing this method also encourages shareholders to raise the stock price because it immediately affects the value of their stock options. Who wouldn't want to maximize their profits while cashing out their options? John gets confidence in his capacity to decrease or eliminate his business tax obligation after considering these 4 corporate tax solutions. He does, however, recognize the necessity to remove income from his firm for personal expenses. To reduce his personal tax requirements, he changes his concentration to investigating ways to reduce his personal tax duties. This brings him to method number 5. Taking advantage of geographical tax advantages. Method 5. Leveraging geographical tax laws. John has successfully built his business in the thriving Silicon Valley over the last 2 decades. However, living in the state with the highest rate of income taxes in the country has finally worn thin on his patience. With a state income tax rate of 13.3% for high-income earners, John finds a considerable amount of his income going to the state government, with extra federal taxes levied. While federal taxes cannot be avoided, John is determined to find ways to reduce other taxes that are eroding his personal fortune. In his search for tax relief, John began studying places with lower income tax rates and was pleasantly delighted to find 7 states that do not impose an income tax, including Texas, Nevada, and Florida. Moving to one of these states would allow him to avoid 13.3% tax he's currently paying, while also enjoying a warm environment all year. As John began looking at home options in each of these states, he wondered whether there were any other strategies he might use to decrease his personal tax burden. Method 6. Investing in real estate. Wealthy people use real estate assets to effectively enhance their wealth. Real estate ownership not only creates income, but also provides potential for tax savings. When you buy a house, it becomes a depreciable asset. You can deduct depreciation charges as the asset's value decreases over time, lowering your taxable income. Other deductible expenses, such as home maintenance and mortgage interest, help to reduce your tax liability even further. But what happens when a property has been completely depreciated? Enter the 1031 exchange provision, which permits you to postpone paying taxes on the sale of your property. You can resume the cycle of depreciation, sale, and reinvestment by reinvesting the proceeds in a new property within 60 days. This ongoing operation allows you to earn rental revenue from your assets while delaying tax payments indefinitely. Method 7. Deferring income. While exploring various options to reduce his taxable income, including relocation and real estate, John still seeks ways to protect a portion of his earnings from taxes. One effective method for achieving this is income deferral through an individual retirement account or IRA, a popular tax deferral vehicle. By channeling his income into an IRA, John can postpone the taxation of his earnings until a later date. IRAs are commonly used by employees to save and grow their funds over time, serving as a reliable strategy for avoiding taxes. Normally, income earned through employment is subject to taxation. However, by contributing funds to an IRA, John can deduct the contribution amount from his taxable income for the year. This approach is particularly advantageous for high-income earners as it reduces their tax burden during peak earning years. For instance, let's say John earns $500,000 annually and falls into the highest tax bracket, where his income may be taxed at up to 40%. By utilizing an IRA, he can potentially circumvent the 40% tax and have a portion of his income taxed at a lower rate, such as 20%. When contributing to an IRA, no taxes are paid in the year of contribution. Instead, taxes are paid upon withdrawal, usually during retirement. Given that retirement income is typically lower than $500,000, the withdrawn funds would be subject to a lower tax rate. The difference in tax rates represents the savings attained through this technique of deferring income. Now that you learned all of these techniques, the ultimate question is, which type of taxpayer are you? Share your thoughts in the comment section below, and don't forget to give this video a thumbs up. Thanks for watching, and we'll see you on the next one.